Hey guys, welcome to another Trade Genius podcast. Got my good friend Bob Kudla. It's 2025, and we're going to kick it off with doing something we've never done before. We're going to be bearish. Let's dive in.
Trade Genius.
To be serious, though, we are probably on the cusp of one of the greatest bubbles ever to burst, and we're going to show you exactly why that is. We're going to show you some charts and things like that, and Bob's got some information for you guys, so let's dive in. Bob, how do you see things going here as we get into January, which seasonally the first part of it's bullish, right? But where do you see things going, or how do you see them playing out?
Yeah, I mean, look, it's really going to be hard. Santa didn't show up. Santa must be Russian because he's now showing up in January, right? So I guess it's going to be an orthodox stock market. But we have a lot of traps now that are set. So, if you believe the quant guys, going into next week already, we have our first trap, right? Volatility is just not abating at all, Phil. The dollar's not abating at all. The 10-year's not abating at all. And a chart I saw this morning, I should have gave it to you, I forgot, is that you have leveraged long positions have 10 times the assets of leveraged short positions. I mean, recipe for disaster. But that's not what I'm even going to show you today. And so really today, I really want to talk macro today because you need to be positioning yourself. We've been positioning ourselves since the election popped, because I just don't trust the market. I was kind of I think I was halfway justified with my bearishness going through Christmas. I wasn't bearish enough on the proxies for Bitcoin, though. So I did take a bit of a hit on some of those names, but overall, everything else I was pretty much right on. But if this next chart should just scare the dickens out of you. Now, this could be 1929 redo, right? Or it could be 1974 redo. And just because what's called the concentration. But this time the concentration is even more than the nifty 50s of the 70s. And why this is important is I just want to draw your attention when you get off the thing. Look at MicroStrategy's chart. Okay, that's what's going to happen to every other high cap stock out there. And there's a few others that are already round trip too. We looked at another one this morning. I forget off the top of my head what it was, but it took a visit to Paris as well. And I think you're going to see this across the board as things start to get more obvious, Phil. Yeah, look at that chart. That's just a disaster. MicroStrategy is not done yet. It has a gap to fill and has another gap to fill. And if Bitcoin does what we think it's going to do after this latest pop, the premium's coming out of MicroStrategy. But going back to these 10 stocks things here is that they're holding up the entire stock market right now. And look at Tesla. Tesla didn't even report earnings. They just reported sales trends, and they took a header. Then you got companies like Palantir out there, Phil. Palantir went parabolic as well. The quantum computing stocks went parabolic. Parabolas, I don't care what anybody tells me, parabolas cannot hold, okay? They just don't hold. So, if you own them, you need to be scaling out of them, okay? Because they've already made their move, and now they're looking for lower highs. And, you may be really good. You may find that lower high, but chances are you won't. You'll ride that whole thing down. But the other chart I want to show you is basically, it's also macro. This is statistical analysis. And what it's basically saying is that for the next 10 years, you can forget about making any money in the stock market statistically. Okay. There's still standards of deviation around that. And since we've been way over, you got to look for those standard deviation pushes to be actually to the downside more so. So you're going to have up years, but you're going to have some pretty nasty spills out there next 10 years. So, which makes perfect sense to me, Phil, because, if you're 65 years old, right, or I'll make it even better. Let's say you're 75 years old. The chances of you making it to 85, you're pretty much at the end of your, I think if you're at 75, you make it to 85 statistically for most people. That's not kind of how it works. But if you're draining your cash hoard that whole time, you're getting more conservative. You're probably moving more money into bonds. You're moving money into money markets, or you're just spending it because you have to live. And that all is going to put pressure on the stock market. You just have to look at Japan and watch China. They have the same problem, but worse than we do. And so you have these issues here with demographics, but then also just statistically, the cash flows can't absorb the market caps. math will work against you. There's enough traders out there that'll beat that into submission. And here's the other thing too, I'll get a little political, is that the Democrats basically abandoned this election, either on purpose or just because people were sick of them, but they happily walked away because they're hoping to hoover Trump. And they've actually come out and even said those kind of things. So those people in the finance world that don't like the Republicans or don't like Trump or globalists are basically going to walk away from the markets, and they're going to let the markets try to find its own footing, which is going to be difficult. Whereas when they want to be with the politicians, they find every reason in the world to lift it. And I think that's problematic. The last chart I'm going to throw over to you, Phil, because this is of your creation, and this is the third nail in the tripod coffin, if you will.
Yep. And we've shared the 2-year, 10-year yield curve chart. This is now the 3-month 10-year, and this is a weekly chart. And the difference on this yield curve is that what you typically are expecting is that once it goes from inverted to positive, which is where we cross over that white line there, that represents a 0 on the inversion or the yield curve. Now we're going back to positive. We're normalizing. So essentially, you're looking for a recession between now and the end of the quarter, essentially into March, for them to. And again, like I've said before, I think this is going to be a backward-looking admission when they finally do say we entered a recession, because I think we're going to get downward revisions on things like job numbers and GDP and things like that. So I think that's how it's going to play out. But essentially, we're going to look for a market structure kind of like what I have overlaid here in red on the stock market. We're just going to have this like rounded top. Essentially, this is where you're going to get a lower high, right, Bob? You're going to retrace the 618 or the 786 of the initial push down, and then once you get that lower high, that's a pretty clear indication that things are rolling over. Meanwhile, all of the different yield curves, whether it's the 2-year 10-year or the 3-month 10-year, will continue to grind up. And then when it comes to like where does this all end, the pain should end once these yield curves start getting back above, at least for the 3-month and 10-year, back above 3.5%. So once we get to that level, then we start looking for a bottom in the market. Meanwhile, between now and then, it's going to take a long time to play out. Typically somewhere between, with the 3-month 10-year, it's somewhere around 100 weeks, 90 to 100 weeks. So that would take us out to actually quite a ways out, well into 2026. So the 2-year 10-year kind of conveys a bear market into the end of 2025. The 3-month 10-year is implying that we may see something way out into 2026. So you have to be open that this recession, if we get it, may be longer than what we're used to seeing. And if you look at things like how long this yield curve has been inverted on both the 3-year or 3-month 10-year and the 2-year 10-year, that would be commensurate with a longer recession. So just you have to be mindful of it. How it plays out, I think, really is up to when the central bank cries uncle, taps out, and decides to capitulate and print again. But again, that's going to be dependent on where inflation is. I think both Bob and I expect deflation. So we will get core PCE or CPE, core CPE back into that range where they typically do print again. So at this point, Bob, how can you make an argument to go and allocate long into this market or, relever up your portfolio? I mean, at this point, these are all such major red flags. You have to start either exiting the market, going to cash, or start building your TLT exposure, because TLT does great in this environment. But if you're sitting there just whistling past the graveyard, I think you're going to be in a world of trouble probably in the next 3 to 6 months. And that's just the initial leg into this. The real pain comes probably about another 12 months out from here.
Yeah, even the most optimistic people that have a brain, not these people that are out there, touting stocks. We talked about this guy before, Warren Pease, Pies. He painted us 2 scenarios, one bearish like we're talking about, and one he called it soft landing. But the soft landing requires the Federal Reserve to continuously cut throughout 2025 and 2026 to bring the plane in safely for a landing. And so either way, I'm sitting there saying to myself yesterday, I said, well, TLT wins either way. The long bond wins. The long bond's going to collapse. The long end of the bonds are going to collapse. So I don't care what anybody tells you about, inflation this, inflation that. You start losing jobs and you can kiss inflation goodbye, and we'll have them panicking over deflation here pretty soon. And remember, Trump, his initial impulse is not inflationary, it's deflationary. He's going to be laying people off. He's going to cut government expenditures. He's going to be looking at everything. And then we have a March debt ceiling to deal with too. So the TGA, they're going to be spending down, their liquidities on the government side. point. It's going to be really interesting to see. But my camp, Phil, the Fed says 2 rate cuts. I'm going to tell you by the end of 2026, we'll be looking at the zero bound once again. And a bad thing about it is that you're not going to want to buy real estate till you get down there, because real estate is going to look pretty ugly. We talked about that and showed that before. It's going to have to take a 50% haircut for you if you're going to be buying something that's fairly long term, because it's going to be basically an L recovery at that point. You're going to own real estate just to live in. You're not going to be speculating in real estate probably the rest of my life. So with that, guys, hey, I'll let you go. I think this is really interesting. Come check us out. It's a brand new year. We think we have a good handle on it. And if Phil and I are absolutely wrong with our macro calls, the algorithm knows all. So it's going to put us in the right trades. And it definitely helps people really guard their emotions, because when they want to do something, you consult the algorithm, and the algorithm's going to tell you whether or not money's flowing in or flowing out of these trades, and whether or not you want to be in those at that price or not. So Phil, thank you. Happy New Year to you. And I'm looking forward to an awesome 2025, regardless of what the market does. Thanks for listening.
Trade Genius.